Hey, welcome to the podcast, everybody. Thank you for joining me. Today is July 23rd, and the S&P 500 closed down on the day. Not too bad, down about 0.2%, down about 3 points, sitting at 1692. The Dow Jones was up on the day, 15,567, up 22 points. And the Nasdaq was the weakest of the bunch today, down 21 points or 0.6%. Interest rates were up to 2.5%, and volatility picked up a little bit. In addition, the small caps and mid caps were pretty much flat on the day. You can see a picture here of the S&P. This is a 5-minute picture. So we opened up, sold off, tried to rally back, and then sold off into the close. So before we get to the picture of the S&P 500 here, just go over a couple things that happened today. It was pretty quiet day overall. You're not seeing a lot of action. It seems like we've been seeing these earnings come out pretty overall. If you look at the percentage of beats on the earnings has been higher. A lot of revenue misses though. So this is one of those quarters that we've really seen a lot in the last year or so, where the companies are manufacturing earnings through savings, through more productivity, but they're not necessarily making it through just the top line growing. And we've seen a lot of misses up there, and a lot in the technology area as well. So technology was weak today. Netflix led the way down, but we've been seeing sell-offs in Microsoft and Intel and even Google, a lot of those companies. And so now Apple, after the bell, actually beat earnings. So we'll see how that performs tomorrow. But overall, the technology has been pretty weak lately, and it had shown some signs that it was getting a little toppy, some of these oscillators we watch. But overall, it's as if investors are ignoring any bit of bad news right now, and so they're ignoring that. They're focusing more on the taper, which looks like it may happen in September, depending on the data, of course. But it looks like we heard today that out of all the economists surveyed by Bloomberg, that half of them believe that they are going to taper from $85 billion a month down to $65 billion a month. So you're still having a lot of money coming into the system, but it's going to be a little lower. So maybe the market's already adjusted for that. And you are seeing some of these things like REITs and utilities and bonds and bond funds and junk bonds and all those types of things bouncing back a bit. A lot of those had really good days. A good day today, despite the market being fairly mediocre. Now, tonight we have the China PMI number, these flash PMI, kind of look and see the how the Chinese economy is doing, because that's been something that has been kind of a bugaboo. And obviously, when you look at FXI, which is a China ETF, it's rallied nicely here, but it has been selling off for most of this year, affecting obviously all the emerging markets. So you've had the emerging market currencies going down, all the emerging market stocks going down, which has helped the dollar, et cetera. And so China's been slowing down, so that'll be an interesting number to see tonight. And then we get one tomorrow from not only the U.S., but Europe as well. But China, last night, it didn't get talked around a lot, it seemed like today, but talked about a lot, I should say. But China came out last night and essentially said, hey, 7% is our line in the sand. If our economy slows down to 7%, then that's as far as we're willing to accept. So we're willing to accept it to slow down a bit, but we're going to potentially reignite if it drops to 7%. That's it. Now, can they do that or not? Who knows? But the fact that they, the fact that they said that, anytime a government says that about stimulus, whether it's Mario Draghi or Ben Bernanke or anybody in China, that seems to put a floor on the stock market. And so today you saw things rally like materials, gold stocks, mining stocks, emerging market currencies. So all the things that have not been working all of a sudden are working, and the things that were working aren't. So, for example, you're seeing a complete shift from things like, if you look at TLT, for example, and that was down today, but it had turned the corner here and started to head back up. So interest rates started to go down a little bit. How about the dollar? You look at the dollar ETF. If you're bullish on the dollar, this is the one you want, UUP. It's been pulling back, dropped almost a dollar from 23 down to almost 22. So the dollar has weakened lately. The stock market's kind of stalled out in the last few days. Nasdaq's obviously been down. But then on the flip side, you see things like gold working. You see things like metals and mining really having a nice bounce from down here around $32 to $37. That's been a big move, led by things like coal stocks were big today. Peabody Energy came out with earnings that were better than what people had expected them to be. Not good, but they were better than what they expected. So those stocks have been beaten up and are rallying pretty hard. So you see metals and mining. Obviously, the gold miners themselves have been rallying, and this was kind of a big day for the gold miners. We've been writing a couple blog articles here in the last few days with some technical pictures of gold, and we'll work backwards. We'll talk about the gold miners first. This certainly, when you look at the 50-day moving average, which is the blue line here, that has been, when it went below that here, that was really the line in the sand. That's when things changed, and you can see it's had trouble, several times, and now we've gone above it. Right here, we've gone above it. So I think, some people still think it's going to be a more weakness to come, and it very well may be. But I think what you're looking for if you're bullish is, and again, we're looking at the miners, not gold, but what you're looking for is a rally, maybe a pullback, because after a big move like this, you'd look for a pullback, but not go back into down in this area, and then we would bounce and head back up. Then you would know that we're in the bottoming process. Kind of like I've used this, kind of like Apple has been making that move kind of sideways for months here, back and forth, and really frustrating short-term traders in Apple. I'm a long-term holder in Apple, but short-term traders are getting frustrated because it's this zigzag back and forth and very hard to trade. Gold may be in that period here. Now, if we look at gold, the actual metal itself, a lot of lines here, but there's some really important ones. And again, this is GLD, so it's a proxy for gold, it's the ETF. Again, the blue line is the place that it's had trouble several times. Even these didn't even get up to it, and we've broken through. So now we're looking for is around the 130 level, which is this line right here. Can we go back up into this range and at least stay in here? If you can, then you look for the next level, which is 140. This is where things like the 200-day moving average come in. And then it could just hit that and head back down again. But what if it does this, and just keeps working its way higher? There's lots of reasons you can make an argument gold should roll back over. There's arguments why it should be rallying. But this is one of those. This is one of those assets, I think, and I've traded gold more than owning it, but this is one of those assets that is a piece of the portfolio. And I think there's obviously been reasons not to own a lot of it. Unfortunately, I've had a very small, tiny piece of it, but there's a lot of people who sold down in this area down here and kind of capitulated. And this is why you own gold, is because while nothing's working in the last 2, 3, 4 days, gold has quietly made a move, from let's call it 1,150 up to 1,300 at least on or let's call it 115 on the GLD up to almost 130. A nice move, sure. And so that's why you own it, because it moves differently. It acts differently than some other asset classes. And so, but for the people who had, 15, 20, 30, 40, 70, 100% of their portfolio, and I have seen people with 100% of their portfolio in gold and gold mining companies, obviously that's been the wrong place to be. But they're getting a little reprieve right now. So again, we're coming up to some important levels here, and let's see if gold can break it on through. It went through the 50-day moving average. Let's see if it can continue up and get into a new range where GLD is in between the 130 and 140 range. And so we'll just have to see going forward what that looks like. Now let's go back to the S&P for a minute. We'll touch on that. And in the past few podcasts, we discussed how we'd broken this trend. We'd been in this nice little zigzag pattern here and this uptrend, and we got out of it, and we said, hey, the test will be, can it get back into it? And it is. It's hanging in there. It's not real strong, but it's hanging in there. So does it fall back down, or do we rally up? There's a lot of data out there to suggest that when you have bull markets like we're in, and you go and test the old highs, and you break through the old highs from way back yonder, we'll call them 2007 highs. So here we are 6 years later, just now getting to where it's at a new high. You will oftentimes make new highs several times, and we've only made made one or two actually, right here and right here. So we've got more to go, but what you see is a correction like we had here, about a 6% correction, and then go off to new highs, and then a bigger correction at some point, which could be a 10, maybe even a 20% correction. And so it's certainly a possibility, and that would still be within the realm of a bull market. And so that's why we have to remain flexible in this, because I still think this thing is going higher. But what's hard is that there's a lot of things stretched right now, a lot of markets stretched very high. Another thing that concerns me is oil. This isn't updated through today, but this is oil as of yesterday. So we're sitting here at actually it says updated today, I'm sorry, 107. And so, oil getting up in this 107 to 110 range, having an effect on gas prices. Interest rates have ratcheted higher. We've seen the home sales hurt on that. Of course, we've seen the home builders themselves fall off, recently because of the kind of the weak data that we've been seeing. And so, home builders are they rolling over? It looks like they might be, but they're at an inflection point where either they need to start rallying now, or they're going to roll over pretty soon and have this, death cross, they call it, where the 50-day moving average crosses below the 200. So you already see maybe some consumers being hurt by higher fuel prices. And then now, guess what we have? We have material prices rising all of a sudden, because in the last few days, materials are rising on speculation that China would come in and stimulate their economy to grow it again faster, which is obviously trickles down to all the commodities, all the materials. And, that's just at a time where maybe when the U.S. is recovering, we can't afford that. So, again, the data over the next, 2-3 months, it's going to be really interesting to watch how resilient this economy that we're in has been, and it has been resilient. One other thing I wanted to show you, municipal bonds. Some of you own municipal bonds I know people that own a whole portfolio full of municipal bonds, and that's what they live off of. And you've seen a big drop-off in muni bonds. In fact, and I don't have a chart of it here in front of me, but you're now seeing across the yield curve for muni bonds are paying more than treasuries, AAA rated muni bonds. So what that means is people are willing to buy treasuries and pay taxes on them in lieu of buying municipals. That shouldn't be that way. If something's tax-free and maybe just as safe, it should be, and maybe they're not just as safe, but they're both AAA rated, so they should be just as safe. But people are willing to pay taxes on something and get a lesser return because they're so scared of munis. And that's something that we may post that on the blog tomorrow to show how often that happens. So you're seeing a big sell-off in munis, and I think it's an opportunity unless, big caveat, unless they do change the taxabilities of these. And that's what hurt them right in here. At the end of the year, the fiscal cliff talks, what happened was there was a theory that they were going to change them and make them not tax exempt anymore because the government needed more revenue. And I thought that was kind of bogus at the time, and they did snap back. The recent sell-off has been because of interest rates, but some of the fear has been because maybe they take away the tax-exempt status. So, that's something that if that law does change, then certainly that would impact muni bonds further, and it may be something where they obviously grandfather existing bonds or phase it in, or who knows how they do it. But remember, muni bonds is how towns get built, how schools get built. I can't imagine them taking that away. I would think they would go after something like master limited partnerships first. I mean, if we look at the administration and who they're wanting to go after, they would want to go after the MLPs, the energy area, first, and change the taxability on those. So that I would think that would happen first. But muni bonds have suffered tremendously, and of course we had the Detroit bankruptcy on Friday. That's not helping either, but you are seeing munis, especially some closed-end funds, some individual munis, start to find a bid here as they become potentially a pretty good value, especially if you see interest rates settle down here and not continue higher. So watch muni bonds, but that's something I wanted to point out. Rarely do you see treasuries paying more than AAA-rated munis, and that's what we're seeing right now. Okay, so I wanted to answer a question real quick, and we'll put it on interest rates so you can see how this looks. Interest rates have obviously risen pretty fast lately. They've kind of broken this little uptrend, so they've at least moved sideways for the time being. You look at things like the 20-day moving average are now this green line going sideways, not going straight up. As the investors debate whether the economy can withstand higher rates, whether the Fed's going to taper, if so, how much. But it's at a standstill right now. And I got an email from a question from a viewer of the podcast who says, it would seem as if the banks actually loaned out more dollars, the economy would be better. Why has there not been more pressure put on the big banks to do that? In of course, in a responsible way. And the answer to that is you can't incentivize banks to lend. Banks will lend when there's demand. And if banks aren't lending, which they're not right now a lot, then you can't force them to do that. So you see interest rates have been doing this lately. Now, banks have been rallying because the yield spreads are wider. So banks lend at a certain rate, they borrow at a certain rate. They're still borrowing cheap, but they're lending at higher rates. They should be doing better. But their net interest margin is that differential. It's how much they make on that loan and borrowing spread. That is not going up or benefiting those banks as much as you would think right now because the loan demand just isn't there right now. And so why has there not been more pressure put on the banks? Again, you can't incentivize them. One way you could, one thing that's tossed around potentially, and something we've talked about is, remember, what's happening here by the banks is the banks deposit the money we talked about this on the podcast, I think last time. The banks deposit the money with the Fed and earn this 0.25%. Why not drop the Fed funds rate to 0 so they're not getting any incentive at all to put their money at the Fed, and then maybe they do go and loan more of it out as an alternative. But right now, when they can make essentially risk-free money, they're not going to loan it out unless there's true demand. And so that's the answer to that. Is you cannot put pressure on them. The only way to put pressure is to grow the economy, and that's not really the Fed's deal to grow the economy. The Fed's trying to grow the economy in the way they think fit, but really what we need is not the monetary stimulus. We need the fiscal stimulus. We need to be able to drill more, not just on private land. We need to be able to have businesses want to hire employees and full-time employees, not just part-time to avoid healthcare and play these little tricks. We need real job growth. That's what's going to cause loan demand. So yes, the banks are doing better than they were, and I like the banks, and I would buy them on dips. But again, you're not going to build the loan demand by pushing on a string and trying to incentivize them. It's just not going to work. If you'd like to get your questions answered, email them to me. And there's two ways to do that. If you want to email me, the best way is to you can always reply to the podcast. That's kind of a podcast email. If you want to email me at the Eggers Capital Management site, eggerscapital.com is that one. You can email me at Karl at eggerscapital.com, and we'll answer it on a podcast. Sometimes if I don't have time, I'll just answer straight to you, and I answer all the emails myself. Also, we're on Twitter, twitter.com/Karl Eggers, Facebook, Google+, iTunes, etc. And eggerscapital.com is the money management website. A lot of people have been visiting the sites in the last week or so we've had a big surge in people viewing the sites, viewing the podcast, the blog, so thank you all for that. All the newcomers, thank you. Feel free to email me, and we'll answer your questions. And also let me know if you want to see anything different on the podcast or articles on topics, whatever you might want to see. We're always open for suggestions because we want to continue to try to make this helpful for you. All right, have a wonderful evening, and we'll talk to you soon.